Hi traders and investors. Seeing as how the market is in a downtrend and we are all wondering when the pain will be over, I thought it would be instructive for all of us, myself included, to measure the last few corrections and bear markets and see how many days they lasted, how far it pulled back, and most importantly, what the bottom looked like. So here is our most recent correction. A correction is between 10 to 20%, a 10 to 20% pullback. And we are looking at about 14 trading days down, and really only, well, at the lowest, it was about 9.5%. So not quite at correction level. That's the current situation. Now let's go back. The last substantial pullback was in August of 2024. Let's measure that one. 15 bars. What did we say the most recent one was? Yeah. So we are just about the same time duration as the correction in August, and it corrected almost 10%. So technically that's a pullback, 0 to 10%, but we'll call it a correction because it's so close to 10%, tomato. And then what did the bottom look like here? We had a gap down, and then a wide ranging day, which finished about in the middle of its range. And then the next day we had a gap up. And the selling here was heavy these final 2 days, and away it went. So we could look for something similar to happen in our current downtrend. Now let's go back farther to 2022. I was trading in 2022, and it was tricky. Actually, you know what? Scratch that. Fall 2023 had about a 10% correction of about 66 trading days. So it did not pull back that far, but boy, it trended downward for a long time. What did the bottom look like? See, we had 3 down days in a row, and then we had 3 up days in a row, and they all finished near the top of their range. That's actually a Japanese candlestick pattern called 3 soldiers. So in theory, after the 3rd soldier, and see how it cleared the 50-day and the 200-day, that would have been a good spot to go long. Okay, now let's go back to 2022. It was, I think, like over a year. Let's see. Now, the indexes, we're looking at the S&P 500. By the way, I should have mentioned that. I apologize. That's the biggest board, the board that is most closely followed by the institutions, etc. The NASDAQ is also very closely followed. It is certainly more volatile in both directions. Now, keep in mind that S&P 500 started rolling over right about the January of 2022, but most growth stocks, NASDAQ growth stocks, were breaking mid-year 2021. And this pullback was 26% in the S&P 500. These are estimates, by the way, but 26%, 20% or more is a bear market, and 195 trading days, which was a heck of a long time, wasn't it? And what did the bottom look like? Let's zoom in here. This was a tricky pullback because not only did it go on for that length of time, but it had 2 major partial retracements. Especially this one here was 42 trading days. So now looking at the bottom here, multiple down days, kind of a spinning top doji, indecision day, sell volume ticks down just a little bit, and then a huge wide-ranging bullish engulfing day, which was 5%, and ended near the top of its range, gave some back the next day, and then continued this uptrend. So after a long downtrend, a wide-ranging bullish engulfing day, look, it engulfs 3 candles here, and the volume is elevated. So that would be another type of bottom for us to watch for. And also noticed within a couple weeks here, we got a nasty double bottom. We got this false bottom, came up, bounced off of a trend line, and then undercut and shook out the last of the unhappy sellers. Here's the COVID bear market. Very unusual in that it was completely an environmental event, medical event, I guess, and unique in its severity and shortness. It only crashed for about 23 trading days. Hold on a second. And 23 trading days, but 35%, 23 trading days, rescued by the Fed, who threw everything but the kitchen sink to protect the market. And here we had some really bearish, wide-ranging days on big volume, a little bit smaller day, and then this was the news announcement. Gap up and away it went into a V recovery. So this what we're looking for in this instance would be some sort of dramatic news event which would gap the market higher. And look how this bar just got stronger throughout the day. That's another indication that the bear market was over. Zooming out a minute, here we are, 2022, 2020. There was another crash here in 2018. Let's zoom in. Let's zoom into that one. All right, here we are, fall/winter 2018. And this pullback was 58 trading days, 20%, just barely met the definition of a bear market. And looking at the bottom here, so we had some initial wave of selling, we had kind of a ledge, a break of the ledge, waterfall crescendo here, big sell volume day. Interestingly, that did not mark the last down day. That marked the second to last down day. And then we had a long bullish candle finishing right at the high, and then a little bit of profit taking, and another one that finished right at the high. Decent, albeit not amazing volume, and kind of a V recovery. Let's go back even farther. Okay, let's see. 2018, we had a little correction. My previous video was on pullbacks, corrections, and bear markets. A correction is 0 to 10. Here we have a 12% correction, 11 trading days, very steep. And we got a couple huge sell bars and big volume. And then this is what's called a demand hammer, where this price hammers way down, and then accumulation takes place, and it finishes up in the upper half of the bar. Ideally, you want the accumulation to complete the bar even higher, but that's what we got. Good buy volume, little gap up the next day, signaled the end, and then it just about undercut it here. That would have been really tricky. Went up for just a couple weeks. This was a really choppy, difficult trading period from January 2018 to May. Notice the volatility contraction: large, medium, small, smaller. That's a classic sign of selling drying up. 2018. All right, what's next? Let's look at two more, and then we'll look at the one of the worst in history, the 2008 bank meltdown. So let's go to mid 2011. We had a very steep, dramatic crash here. And this was 52 trading days, 20%. Just meets the definition of a bear market. This would have been a really tricky one to navigate. You had this waterfall crash and then some really choppy sideways volatility, demand hammer at the bottom. But I don't think you could trust this uptrend until it broke through the top of this rectangle, Darvas box, I guess we could call it. So I suppose we could look for a waterfall crash and then some choppy volatility resolving to the upside. Let's go back a little farther. 2010. Boy, one thing I'm noticing is just how ugly downtrends really are. You get these huge sell days. Look, this bar here was 8.5%, and the S&P 500. At one point, the S&P 500 was down 8.5% on the day. That's amazing and very rare. This downtrend was 17%, so just a correction. 48 trading days, that's a long time. Lots of volatility. And what brought us out? Multiple days of heavy selling. Then this is called a dragonfly doji. It's a type of accumulation hammer. And then an inside day. And then a spinning top doji, which is an indecision day. And then a strong uptrend day. So I think we could be fairly comfortable going long here. 7-7. 2010. And let's wrap this video up with the granddaddy of them all. Well, besides the dot-com crash and then I suppose the Great Depression, but 2008 was terrible. Rolled over October 2007 and traded down 356 trading days. Keep in mind, that's not including weekends. So that is over a year, October 2007 to, looks like about March 2009, year and a half. A couple relief rallies in there, 45-day uptrend there. And how did the bottom look? So we got this pinchers or railroad tracks formation in November 2008, which hammered in part of the bottom, and then it rolled over again, and then we had an exhausting number of down days wearing out all of the sellers, and then we had a spinning top doji. Now these if it was in a mild uptrend like this, spinning top doji is not a big deal. But when you get one like that after a huge bout of selling, in this case 27% down, that's a big indication that things are flipping from sellers to buyers. And then we got a weak sell-off day and then a really strong up day that finished at the top of its range. So we can conclude from this a few different things. That sell-offs are dramatic and messy and ugly and volatile and difficult to ride through. And as far as bottoms, there's different things that we can see. But among them, we want to see multiple days of heavy selling. We want to see some sort of indecision doji or a large bullish white candle finishing near the top of its range, a gap up perhaps, a double bottom perhaps. Those are some things that we should be looking for. I'm trying to get to 2000, trying to get back to 2025. And we have had a dramatic, wide-ranging down days, that's for sure. Selling was elevated today, March 10th. Honestly, this could be it. A lot of these corrections are right about 10%. What we want to see now is, like I said, a gap up, spinning top doji followed by a gap up, some sort of bullish engulfing day, some sort of sideways ledge that resolves to the upside. Those are some things we'll be looking for. All right, let me know your thoughts and comments. And hey, I do a Patreon. I have a Patreon portfolio and focus list that I show my members every weekend. If you're interested in that, check that out in the description below. And please check out my partner, Seeking Alpha Premium. Also link in the description, my go-to place for fundamental analysis. I will be glad when this downtrend is over, and I'm sure you will be too. This too shall pass, as the saying goes.